Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm the senior trader for the Forex Super Model, and this is Trading Psychology Series Part 9, How to Profit from Forex Trading Biases. Now, biases is an enormous subject in trading, and let's just do a whistle-stop tour of the basics very quickly though, so I don't put you to sleep. So first thing to do then is a bias, and quite often they're talked about of cognitive, to use the jargon, cognitive biases. And so cognitive basically means involving conscious intellectual activity or thinking. So it's a thinking bias, if you like. And a bias is some form of inclination or prejudice. So that's what a bias is, and they normally talk about cognitive biases. Psychologists tend to talk that way. They use the jargon of cognitive biases. So that's basically what we're talking about, and obviously from our perspective, we need some sort of structure to get involved with this. So the first thing we've got to do, we know what a bias is now. We've recognised that it's a thinking bias. We now have to have some sort of bias recognition. So bias recognition. I mean, if you go onto the internet and look up trading biases, there's literally tens of them. You know, I've seen 50 top trading biases, and then you'll see the top 5 and all the rest of it. So there are a lot of these biases in trading, and not just in trading but in general life. But anyway, we're talking about trading. So bias recognition. So the first thing to do is to recognize the difference between your biases and someone else's biases. Now, the obvious bias that you have, even if you believe you have no bias, is that as soon as you trade, you are in the market, and you tend to do what's known as thinking and talking your book. So, for example, when we were in a long-term positional trade on the pound, it's very difficult for us not to think in terms of just as a focus where we're long the pound, and therefore we had, whether we liked it or not, we had a bias towards the pound. Okay, and that wasn't necessarily a negative thing, but it was nevertheless, it was a bias. So the first thing to realise then after that is that there's a spectrum of bias. So you can be here, you can be here, or you can be here. So you can be positive, neutral, or negative. Now, what we mean by that is you can have, obviously in basic terms, you can have a negative bias towards something, like we had a positive bias towards the pound in that instance. And even if you have a neutral bias, that is still a bias, but it's a different type of bias, because if you're neutral about something, if you're truly indifferent, to use the economic jargon, then you won't care whether factors are coming in positive or negative. But you may, because you're neutral, you may have an actual sort of like a buffer zone in your mind to actually buffer out any positive and negative influences. So that's something to bear in mind. Now we're going to look at some biases which we're not going to grind through all the usual biases. We're going to look at some more unusual ones which has come to the fore more recently and which will be of more use to you. Now let's just shuffle this stuff around a bit. Hang on, get rid of that. Right, so the first bias is created by sort of industry norms and education and all the rest of it. The first bias that is the trade is your friend, that the trend is your friend. Not the trade, it could be a friend. So the trend is your friend. Now, what this tends to mean is that a lot of traders, if they can identify an uptrend, for example, higher highs and higher lows and all sorts of other definitions of uptrends, but that's one of the main ones, or a downtrend, lower lows and lower highs, then they have a long bias if they've identified an uptrend. So they have a long bias and they have a short bias if they've identified a downtrend. In other words, they will only take long trades in this situation and short trades in this situation. Now this is a bias that you can profit from, and the market makers take these people to the cleaners regularly, because what tends to happen is that they whilst it's very time frame dependent, and whilst there may be a long-term long bias on smaller time frames, which is the here and now, which is when your day trading brigade and all the rest of it are trading, then the market manipulators and makers are able to take advantage of this long bias, or short bias, and they take advantage of your stop positioning, your risk control, and they'll swing you into a position where you're going to be stopped out. So that's one thing to look for. If there's an obvious long bias, beware. If there's an obvious short bias on sort of day trading charts, beware, because everyone's going to be thinking that way, the majority of them, and the market makers are well aware of that. So that's how you can profit from a long bias or short bias. The trend is your friend, and it may be your enemy. So that's one of the first ones. Then there's this so-called asymmetric bias. Now this sort of feeds into, as I said, we've been long the pound we're out of the market now, but we've been long the pound for literally months, and this was throughout this whole sort of Brexit trying to get a deal period. Now this there was a tremendous asymmetric bias here. Now what do we mean by an asymmetric bias? I mean, what we mean is that if information goes one way, it hardly has any effect, and if it goes the other way, it has a big negative effect in this case. So or positive. So and this was the euro, and this was the pound. So there was an asymmetric response. In other words, an imbalanced response to the Brexit noise. Now, every time there was relatively bad news on the trade talks, the pound would get hammered and the euro would naturally be on the up. every time there was good news, the pound would surge up, and the euro would get naturally hammered, relatively speaking. But normally, the general tone and sentiment in the market was for quite some time was to hammer the pound, and that was off the back of analysts saying that all the detrimental effects of leaving the EU were going to be felt in the GBP, the UK. The UK was going to bear the brunt of all these problems, whereas the EU was going to, because of its numbers and all these other good reasons, was going to just weather it and actually gain from the fact that the pound was suffering or the UK was suffering. So you had this asymmetric response, and then as if you've been following the markets, you'll realise that there were tremendous opportunities in buying the pound at these low levels, and the pound is now at pretty high levels. So that would be an example of a bias you could profit from. Would be some sort of asymmetric bias then. So let's have a look at something else. Now these are becoming increasingly common, funnily enough. Now the next thing is a political bias. Now the last 18 months or so have been sort of phased around the US elections, and whether you like it or not, as traders, we generally should, normative statement, we should not get involved in any form of political biases at all. But humans being what they are, they tend to be sitting in certain camps, and some of these things are very prevalent. And the political bias, be it towards Trump or against Trump, was very strong, and there were tremendous trading opportunities there. So that's one thing to bear in mind, is that political bias, it is very influential and becoming increasingly influential in trading. Likewise with geopolitical bias. So, but political bias is one which is on the up, and linked to that, you've got climate or environmental bias. I say it's linked because quite often one side likes to take a moral high ground on climate change. It's more in their structure, and the environmental bias is linked with that. So the key thing with all these biases is how do they manifest themselves in the market. So you need to recognise price action in the relevant financial instruments. How is it correlated? So with climate change and environmental bias, you've got all sorts of issues there, but particularly in equities, and you've got price action. Oil market would be a good example of climate and environmental action, and travel, anything which burns the juice basically. So price action then, is it actually reflecting this bias? Is it neutral to the bias, or is it running against the bias? So these are things you need to look at, and that's how you can profit from these biases. Is to look at how are they being reflected in the market, and if they're being reflected in the market. So that's that. And then you've got the big one here. You've got analyst biased. So you've got analyst bias. Now, depending on where you're getting your information from, different analysts have got different agendas. They've got they suppress certain information and they pump up other information, and they're grinding their own axe for their own ends. Now, banks are particularly bank reports are particularly prone to this, upgrading certain stocks, downgrading certain sectors, that type of thing. So just be aware that what the analysts may be seemingly doing you a favour, but what they're doing is they're creating an environment where their institution or their people can benefit from that situation. So there'll be an analyst bias, and if you can recognise that, then you're in the driving seat for making Forex profits. So that's analyst biases. And then we can move on to indicator bias. Right, so one of the most common indicators is the RSI, Relative Strength Index, and the 50 is the so if it's less or equal to 50 or greater than equal to 50 is quite often a key element to this. And again, obviously it depends what time frame you're looking at, but if you stick in a standard RSI on a 1 hour chart, the day traders and the 4 hour chart, the day traders are going to be all over it. And if this 50 mark, if the market starts to come up to the 50 mark, you get tremendous interest in this. And if it actually manages to break the 50 mark, then you get the breakout traders throwing their hat in the ring and having a go. And likewise, and this is a classic bias, and this is what the market makers are very aware of, and they may even engineer a situation where they allow the market to actually go through key technical levels like RSI 50. And another one is divergence. So divergence, which is often linked with the other popular one, MACD, MACD. So just be aware that what seems like a textbook situation and is a bias effectively. So divergence means we're going to get some sort of reversal normally, and a push through the 50 on the RSI means we're likely to get a breakout. And likewise with moving averages. So you've got moving average crossovers, moving average cross, and if you actually look at our video on moving averages, hidden secrets of moving averages, you realise that the crossover point of the moving average is actually very misrepresentative of what's going on, because it's due to first and second derivatives. So if you don't know what I'm talking about, have a look at that. So moving average bias, the cross is another example of that. And likewise with moving averages, biases of multi-touch. The multi-touch support carries more weight. There's a bias for you. So, and depending on the time frame, the market makers are very well aware that if they can get the market to touch certain moving averages many times, and then seemingly the market goes off, then they know that all the stops are here, and that's when they're going to take you to the cleaners. So you can gain tremendous opportunities through just understanding the way people work and their particular biases, cognitive biases, the way they think around certain things. So we've got indicator biases, and we've also got let's just get rid of this so we've got some room. We've got pattern biases. A lot of traders like patterns and are taught to use them. So pattern biases, if you like. So head and shoulders is a lovely pattern to have a bias on. The old neckline syndrome, and then market makers are well aware that if it breaks the neckline, that people are going to be piling in short, and so on and so forth. So, and obviously that works for the other way around. So head and shoulders, trend lines. There's a tendency to have a bias to think that a nicely fitting trend line with the market sort of using that as it somehow gives you an edge, and market makers are well aware that they can use trend lines and in fact all indicators against you. So that's where we're at there. Let's just swing this over again. Right, so if you remember, get rid of this so we've got some room. We've deliberately avoided all the usual biases, but I can just talk to a little bit about, I mean, the normal biases that are trotted out by the educators are anchoring bias, recency bias, loss aversion bias, bandwagon bias, confirmation biases, and FOMO, fear of missing out biases, and then we've got another one here, which is the ego bias, which is that the need to be right. Now that's more of an individual bias, so that's something you need to watch out for on yourself. The need to be right. So and how do you know if you have biases? Basically, well, you can look at your past performance. That's where maybe your trading journal comes in. Your trading journal, we've done a video on the importance of trading journals, not as a documentation of the process, but as a means of identifying patterns in your behavior and your biases. So that's the main area of that. So to wrap this up, how to profit from Forex trading biases. Right, so first thing is to understand what a bias is. So a bias is a way of looking at things. It's a cognitive way of thinking, which is detrimental to certain other areas of information. What is a bias, and then what are the type of who are the players that have biases? There's yourself and external influences. What are the main biases? What are the main modern biases that are coming through? And we think there's going to be an increasing asymmetric bias coming through. And obviously an asymmetric bias is quite a difficult one to sort out because they tend to have an on-off switch. Everybody has this sort of situation where they think the pound is ugly, and then suddenly it's not ugly, and everything switches. So you need to have be aware of the asymmetric nature of the bias. So just as a final summary, then, you can profit from other people's thinking and your own thinking once you recognise the nature of the cognitive bias. And the most important thing is to link that with the current price action. Has the market been behaving as if there is a bias or not? And remember the spectrum. Is the bias positive, neutral, or negative? Now I hope that helps. Look out for the next video. Thank you very much.